For decades, one of the biggest puzzles in finance has been this. Why do boring stocks seem to beat sexy stocks over the long run? It's a question that has stumped some of the brightest minds out there. But today, we're going to unpack a groundbreaking paper from 2005 by Lu Zhang that offers a really elegant and actually a surprisingly intuitive solution. So here's our game plan. First, we'll lay out the puzzle itself. Then, we'll get into the radical new theory that just flips the whole thing on its head. We'll dig into the two core economic forces that make it all tick, see how they reveal this hidden risk in value stocks, and finally, we'll put the theory to the ultimate test against the real-world data. All right, let's dive in. We're starting with the core mystery, a question that for a long, long time made it seem like the stock market just didn't make any sense. I mean, on the surface, this is just bizarre, right? Growth stocks, we're talking tech startups, companies all about future potential, innovation. Value stocks, well, they're your established, often industrial companies. Think factories and heavy machinery. So why on earth would the slow and steady tortoise consistently beat the flashy hare? And this is where we hit a major contradiction. You see, basic finance theory, Finance 101, tells us that risk and reward are two sides of the same coin. A growth company's entire value is tied up in these uncertain future projects. That sounds super risky. So they should deliver higher returns to pay you for taking that chance. But when you look at the actual data, the market is telling a completely different story. And look, this isn't some tiny statistical blip that you can just ignore. We are talking about a pretty significant difference, a 4.68% annual premium on average. Over decades, that kind of outperformance is absolutely massive. This is what we call the value premium, and it's the mystery we're here to solve. Okay, so the old theories just weren't cutting it. Then along comes Lu Zhang's 2005 paper in the Journal of Finance, and instead of trying to cram the data into the old theory, he proposed a radical new one by completely flipping the script on what we think of as risky. This quote right here. This is the entire explanation in a nutshell. What Zhang is arguing is that we've been looking at risk all wrong. The real danger isn't in what a company might build in the future, it's in what it already owns, especially when the economy really takes a nosedive. So the crucial thing to grasp here is where each company's value actually comes from. For a value firm, it's the physical stuff, the assets that are already in place. For a growth firm, it's all about potential, the growth options. And this distinction, it's everything. So how does this work in practice? Well, Zhang's theory isn't just some clever idea. It's built on two really powerful economic principles that pretty much govern how all businesses operate. Okay, the first one is called costly reversibility. Just think about it like this. Buying a brand new car is pretty easy. You walk into the dealership, you sign some papers, you drive away. But trying to sell that same car a year later, it's a hassle, and you are never going to get back what you paid for it. It's the exact same for companies. Expanding is the easy part. Shrinking is hard, it's slow, and it is very, very expensive. And this chart just lays that asymmetry out perfectly. The cost for a company to expand, it's manageable. But the cost to shrink, selling off a specialized factory, laying off skilled workers, that is dramatically higher. This isn't a small difference. We're talking about a fundamental imbalance in how business works. The second principle is the counter-cyclical price of risk. And this one is really more about human psychology. When the economy is booming, everyone's feeling optimistic, they're willing to take chances. But when a recession hits, fear just takes over. Investors become extremely risk-averse, and they demand a huge premium to take on any risk at all. Basically, risk is on sale during booms and incredibly expensive during busts. And now for the magic. Let's see what happens when we combine these two powerful forces, that high cost of shrinking and the soaring price of risk during a downturn. This is where the true risk of value stocks finally comes to light. Yeah, this is the ultimate stress test. Good times can hide a lot of flaws, but a recession exposes the fundamental weaknesses in any business model. So let's put our value and growth firms to the test. So during a recession, demand just plummets. That giant factory the value firm owns, suddenly it's half empty and it's losing money. And because of costly reversibility, they can't just sell it off. They are stuck. They are completely inflexible. The growth firm, on the other hand, it can just put its big expansion plans on hold. See, it's way easier to not build a new factory than it is to get rid of an old one. They are flexible.
This is the perfect way to picture it. The value firm is this massive, fully loaded cargo ship. When a storm hits, it can't turn or slow down quickly. It's just at the mercy of the waves. The growth firm, though, that's a speedboat. It can easily change course or just head back to shore and wait for the storm to pass.
Now, what's really interesting is that during economic booms, the situation kind of flips. Growth firms are the ones spending heavily, facing costs to expand and chase new opportunities. Value firms can just fire up their existing factories to full capacity, so the risk gap between them narrows a whole lot. The extra riskiness of value stocks is really just a bad times problem. And that right there is the absolute key. The inflexibility of value firms makes them suffer the most during recessions. And, as we just said, recessions are exactly when investors are most terrified of risk and demand the highest possible compensation for it. It's this perfect storm of high risk hitting a high price for risk that actually creates the value premium. It's a beautiful theory, isn't it? It's elegant. It makes total sense. But does it actually hold up? Let's see if Zhang's model can survive a collision with reality. This is always the moment of truth for any economic model. I mean, you can have the most brilliant theory in the world, but if it doesn't match the data, it's really just a nice story. So how does Zhang's model do?
Extraordinarily well. I mean, the results here are genuinely remarkable. The model, which is built from the ground up on just those two economic principles, it predicts an annual value premium of 4.87%. And the actual historical premium in the real-world data, 4.68%. That is an incredibly close match. It's really powerful evidence that this theory isn't just plausible, it's potent.
And it gets even better. A strong theory doesn't just explain one thing. It explains a whole cluster of related things. And Zhang's model does exactly that. It correctly predicts why value firms tend to be less profitable, why the premium gets bigger during certain economic cycles, and it even explains the investment patterns of both types of firms. It provides a single, unified story for a whole host of market behaviors. So the crucial takeaway here is this. The value premium isn't an anomaly at all. It's not a market mistake or some evidence of irrational investors. No, it's the logical, predictable outcome of rational companies and investors just operating under real-world constraints. It's a risk premium, but it's for a type of risk we just weren't looking for before. And that leaves us with a final thought to really chew on. We spend so much time celebrating growth and expansion, but maybe, just maybe, the true measure of a resilient business and the hidden risk we so often overlook lies not in its ability to get bigger, but in its flexibility to get smaller when trouble arrives.